2 poison pills that will actually fix the economy. That's what I want to address and talk about in this video. And it's a follow-up video to a couple other videos I've done and have gotten good feedback. But where does this all end? Where does all this inflation and gas prices and interest rates and housing market, where does this all eventually lead to? And at the core, it's a good thing because it's going to force us as a country to address the actual issue and where this is all stemming from, and hopefully we make the right decision. But those decisions do come from a couple of poison pills because whatever decision is made, it's not going to be pleasant, but within the big picture, it will fix the economy and will put us ultimately in a much better spot. But before we can get to all of those poison pills, we need to first set up the context of these nuts and bolts and address the core issue that we face and what all this is actually stemming from. So right here, you can see a chart which maps out the gross federal debt to GDP. GDP just means how big is the United States economy compared to the debt. And right there, you can see that the debt is bigger than our entire economy. It is 137.2%. And that is just a bit awkward. Think about it. The size of our GDP, the debt is larger. So in other words, we have a debt problem in this country. I don't think I'm necessarily saying anything new, but I was not aware that it was that much of a problem. I had no idea that it was bigger, and not like a little bit bigger, 137% bigger. So yes, we have not a debt problem, a very, very big debt problem. Okay, so where did all this come from? How does this actually happen? So right here you have our trends over time of basically the United States budget. And the colors to look at are right there, we'll call it a brownish, and then right there the yellowish of surplus. And as far as surplus, that's what you want, right? That's where you make more than you spend. So if you have a surplus in your monthly budget as a person or as a family, that's a good thing. You now have money you can set aside to invest and do many other things with. But if you have a deficit, well, that's where people get, well, dare I say, debt problems. So when it comes to the deficit, you're seeing a whole lot of that brown. In fact, the sad part, the last time the US government had a surplus was in 2001. How pathetic is that? Over 20 years ago, since we as a country have been able to bring in more than what we spend, that is really, really sad. And once again, one of those statistics where I didn't realize it was that bad. But that is really, really pathetic. So that brings up, okay, well, how is this all being paid for? Well, just like as a family or as you, let's just get out the credit card. The government has credit cards and they just pull those out and they just start spending and spending, and anything that they can't actually afford, they just put onto the credit card. Which brings us to the next thing. Okay, what is the breakdown of all this spending? How is it all working? Where does all this money go that we're putting onto our credit card? So right here, you can see the categories of our spending, and the big ones are coming from, and let me take a step back. The one that matters right now is this one down here, the net interest from the debt. So basically, let's just look at that as our credit card payment as a country. And that one right now is at 5%. And the key thing that right now, all this is based on, these poison pills, which we'll get to, is the fact that the government, everybody, economists, they are assuming, they are more so hoping that that number stays calm. Stay calm. Stay calm, right? That's what they want, to stay calm, because if it doesn't stay calm, well, that's going to create some issues. So just keep that in mind. They want that to stay calm. Now, what is the indicator? What is the dynamic that's going to dictate whether or not that stays calm? What do I mean by staying calm? Well, we've got to determine, we got to figure out what is the credit card payment amount. And like anything, a credit card payment is going to have some sort of interest rate attached to it. And you want the interest rate to remain as low as possible. So that's why in this situation, stay calm, stay calm. Because as long as it stays calm, then that 5% will stay around 5%. However, how do we know, what can we use to measure whether or not that credit card payment is going to go up or not? And that's where we have here the US 10-year Treasury, which is a great indicator to watch because that's, again, going to serve as, let's just call it, that credit card payment amount indicator. And if you want to follow it yourself, which I would highly recommend you do, just run a search for 10-year US Treasury chart, and you can keep an eye on this too. But the dynamic here, right now, that's the number that you need to be watching, that percentage, because that's going to serve as essentially the interest rate that's needing to be paid for that credit card, because a lot of this is determined by these treasuries. Now, there are other treasuries out there, but the 10-year, I think, is a good middle ground to watch, to just keep an eye on, okay, how expensive are these credit card payments getting? Maybe they're getting less expensive if that goes down, but all sorts of people are going to be watching that level for that event. And the thing is remember, that's the one that we want to stay calm, because if that stays calm, then that means that the 5% on the budget stays calm. However, I did the video there, and I'll put a link down below if you want to watch it. But basically, I'll summarize that video for you right now. If the Federal Reserve does what they have told us that they're going to do, that they're going to reduce their balance sheet, that they're going to continue to raise the Fed funds rate, then that means that this chart is going up, meaning credit card payment amounts are going up. And that's not, an opinion, that's just what they've told us. So let's revisit this under the premise that credit card payment is going to go up. Well, as that credit card payment goes up and you want it to stay calm, well, that 5% right there is no longer going to be 5%. That is going to get higher. And the problem here is something that we've all learned about: compounding interest. Usually you hear about it in a good way, like start investing now because numbers will build upon themselves, and then they build even quicker, and then they build even quicker and quicker and quicker. Well, in this situation, it's not the type of compound interest we want, because in this situation, that's what it's going to lead to. It is going to lead to the interest getting way too expensive, way too fast, and it will literally be like an explosion, and it will happen very quickly because it's just going to start to compound upon itself. Because, like I said again, if the Federal Reserve does what it says it's going to do and it pushes up those interest rates, that credit card payment is going to start to get more expensive very, very quickly. So at this point, we're now going to have some things that we have to address, and this is the core. The core is a spending problem. The core is a debt problem. So with poison pill number one, we need to break down a couple things. So between income security, Social Security, and then a bunch of health benefits, that equates to 53% of our budget. So 53% is into three categories. Now, I'm not saying what I'm about to say can't be done to other categories, but it's going to have to definitely be taken from at least some of those categories when they make up 53% of the budget. And what is that would need to be done? Well, get out the knife, sharpen it. The government is going to need to get smaller. The government is going to need to cut spending. So if that means less Social Security, that means less medical benefits. I mean, that can come in many different forms, but the government is going to need to cut spending. Why? Well, because more spending now needs to go to that national debt, which is spiraling out of control. So it can be done. It can be addressed. You can make those payments and start to reduce those payments if you free up other money in the budget. And you free up other money in the budget by, that's what politicians say. Hey, let's free up money in the budget. But what's actually being said is, let's cut spending in the budget. Let's make government smaller. Now, the next thing you could do, though, if you say, no, I don't want to cut spending, so that's just not going to happen. Okay, so poison pill number two would be, all right, well, then guess what? We have to raise taxes for everyone. Now, I know that says double taxes, but I'm not necessarily saying taxes would need to double, but that's just what I could find. So taxes for everyone, not tax the rich, because that's not going to be enough. So I get it. That's kind of a popular talking point. But in this situation, to service the numbers that would potentially be thrown out by this debt and this credit card payment that's exploding, it's going to mean taxes across the board, not just for the rich, for everybody. And it's also going to mean none of this, hey, we have this new program, and we're going to tax to pay for it. Okay, but we need to just tax to address other issues. We don't need to add more spending. Remember poison pill number one, to actually cut spending. So certainly you don't want to be adding more spending to the budget. You should be at best case, keeping it flat. No more spending at best case. So that's what you got to do. Anybody that's talking about more taxes, and more taxes usually being associated with, well, more spending. No, we don't need more spending, and this is exactly why. So right here, going to be taxes for everybody. Now, at the core, this leads us to a third potential pill, because maybe you're looking at cut spending. Nope, not going to do that. Okay, let's raise taxes for everybody. Nope, not going to do that. So what does that actually leave the situation with? What is this third pill? And this is what I call the death pill, because it truly would be game over. And that would be, you know what, let's just inflate the money supply. Or in other words, in terminology that you probably heard, let's print money. Turn on the printing press in regards to money. So what is that going to do if we inflate the money supply by just throwing more money out there? Well, when it comes to the value and prices all around you, those are going to rocket. Absolutely skyrocket insanely. And if you think higher prices are bad right now, then you haven't seen anything yet if this third pill is chosen. And that's why I call it a death pill, because it would literally, metaphorically send prices skyrocketing, because think about it. What did we get here right now? Well, because of inflating the money supply, because of printing too much money. So wait a second, we're trying to fix the printing too much money problem by all of a sudden printing more money. Do you see how that makes zero sense and how that would just completely defeat the whole purpose of what we're trying to accomplish right now? So those are the poison pills that we are going to face as a country. Hey Clay, what do you think is best? I would vote for cutting government spending. Maybe even now, and I'd be open to an increase in taxes too, with the contingency, are we also reducing some government spending? And if we reduce some government spending, then you might just need a little bit of a tax increase for a few years. And then you can map out the numbers and say, hey, we're going to cut spending here, here, and there, but we're also going to raise taxes here, here, and there a little bit for only, 2 years, 3 years, whatever it is. But by doing so, now you're going to see that we're actually starting to run surpluses again as a country. That is my core goal, is how do we get to having a surplus where we as a country make more money than what we spend? So if we get there through a combination, I'm up for that. I would like to think that we could get there through just spending cuts, but I'm also open to, okay, let's do a combination of spending cuts and, tax raises for a limited period of time. But at my core, I want to see that graph. I want to see more of those trade surplus bars, not deficit after deficit after deficit. So what are your thoughts on all this? What poison pill would you choose? What one do you think would work best? Let me know down in the comment section. And surely, hopefully nobody says death pill, but I suppose if you choose that one, maybe you have some sort of good reason behind it. I'd love to hear that down in the comment section. But yes, please, I'm genuinely curious. What are your thoughts? What poison pill do you believe will be the best one to use here when we reach that point? Because it's going to happen. There's no doubt that if the Fed does what it says it's going to do, we're going to eventually reach that point where those are the discussions that are going to need to be made out there. And we'll see what happens at that point. And hopefully, we don't choose as a country the death pill, and as things will then officially really, really spiral out of control. So let me know your thoughts down below. If you enjoyed this video, if you'd like for me to continue to do more current event videos like this, hit that like button, leave a simple comment below. Is there a topic in the news right now you'd like me to discuss? Some sort of economic topic, any topic? Please leave that in the comment section, and I'll take that into consideration for sure. So hit that like button, leave a comment, let me know what poison pill you'd prefer. Everybody take care. Have a good one. First off, thanks so much for watching the entire video. Real quick, before you go, I want to invite you to a live webinar, web class, training, workshop, online event, whatever you want to call it, but it will be me live revealing to you what I've discovered that has allowed me to transform myself from being an employee to being my own boss, including how I had only one losing day out of 73 days in total. I'm going to cover 3 keys that have helped me unlock profitable consistency within the markets. The first key is super weird, but in a productive type of way. The second key is super awesome because it quite literally is wired into our DNA as humans, making it very easy to use. But in a cruel way, this becomes a pitfall for many traders. I'll explain it all though, including how to avoid the pitfall that it creates for some. And yeah, the third key, when you hear it, sounds way too good to be true, but it's not, and I'll show you how it all works. Then at the end, I open it up for a question and answer session that is, again, totally live. Even if you can't make the live session, please still sign up as it will be recorded, and you can go back and watch the replay that I will send you. Click the image on the screen or click the link down in the description box so you can get the date and time and claim your spot, which I should note is limited due to the fact that this truly is a live event. If you have any questions, let me know. If not, I'll be seeing you soon.